Hello everyone and welcome to today's Cash Flow Masterclass. A little bit about me. My name is Heather Waldenmeyer and I have been working in construction finance specifically for over 15 years. I started my career at KPMG and then I realized I could have a more profound impact as an auditor and a consultant for small, closely held companies, and I went to work for smaller, more boutique CPA firms. I immediately fell in love with the niche complexities of construction finance, and I never looked back. As a consultant for many years, I became very involved in the Construction Financial Managers Association and the Institute for Certified Construction Financial Professionals, and I served as the national chair of the institute, and I made it my goal to bring what had always been a paper and pencil exam and overview course online. I then took all of this knowledge that I had built up from working with hundreds of clients as a consultant and as an educator for CFMA, and I started applying it directly to organizations in private industry, serving as the VP of Finance for companies of various shapes and sizes. And what I found working in large international engineering firms versus small, closely held contractors was that the root issues were the same. Cash was tight, credit was hard to come by, and there had to be a better way. Over my last 10 years I've spent in private industry, I have worked through more than one fully extended line of credit that was paid down completely within a year using similar techniques, so I know it can be done. Hopefully I can share some of those techniques with you today to help you bring additional value to your organizations. So, how do financial managers help the bottom line? Obviously, we are the most intimately involved with cash. They say it takes money to make money, so I broke down my main strategies for improving cash flow into these 4. The first is directly generating cash from within the overhead of the business. This is not just charge more for your work, although that's great if you can do that, but this is actual strategies that we can put in place to turn our accounting departments themselves into cash flow generators. Then there's your authority and your education. Believe it or not, having credible financial managers and staff can have a direct impact to your bonding capacity, underwriting decisions, and you will be the best equipped to seize opportunities for cash flow as they arise. But we can't be expected to know everything all the time, especially in times like these where everything is constantly changing. So we need to rely on our relationships with peers in the industry, advisors, vendors, and clients to help keep us in advantageous cash positions. And lastly, we have to always keep our eyes on the horizon. Sometimes cash can be easy come, easy go, and one of the most important ways that financial managers can impact cash flow is to be an early warning system. Adding value is kind of like a butterfly effect, and I like to describe it with this little flywheel. They say it takes money to make money, and this is true. Many of the strategies that I implement involve investing in a software or investing time in updating processes or procedures. In the beginning, especially if cash is tight, it may not be feasible to invest that kind of money or labor, so we have to start small. We invest a little bit of time in some small actions that will generate cash flows. The returns generated from those efforts are then reinvested back to fund additional cash flow generating activities. And pretty soon, the returns accumulate to the point where you can really drive value for your organization. So what do I mean by cash generating activities? First, we have to start with the accounting department. Because accounting is an overhead line item, it's very tempting to want to keep that expense as low as possible. But if you flip that script and instead look at accounting as a profit center, it helps to emphasize the department's ability to impact cash flows directly and can improve financial performance overall. When we try to keep this overhead amount too low, we can make some pretty costly mistakes. The first being understaffing. Many companies pride themselves on running lean, but lean doesn't always mean efficient. Being understaffed can actually have a significant impact on cash flow. The Association of Certified Fraud Examiners estimates that 5% of revenues is lost due to fraud and errors. Running lean is many times at the expense of a system of checks and balances that can help catch leaking cash. For example, double paying your invoices or inappropriate employee expenses on credit cards. The next is, that's the way we've always done it. When we run too lean, we don't leave enough time for innovation. Everyone is too busy pushing their paper from one side of their desk to the other to stop and think if there's a better way. Managers need time to mentor and coach employees, to properly review invoices or journal entries, or to dive deep into your processes and procedures to make sure that those processes are really working efficiently. Many times, a process was put in place many years ago to address a risk at the time, But as time goes on, that may no longer be an issue. For example, keeping multiple paper copies of invoices once you've paid them, when that invoice has already been scanned and electronically routed, may not be efficient anymore. That original process served a purpose at the time, but it may not be adding much value today. Freeing up time spent on activities that don't bring much value can be reinvested back into initiatives that actually bring value and thus set the flywheel in motion. One of the most common ways that I see that's the way we've always done it in full effect is when we have things that are done in-house that can be outsourced. Many times, the idea that we are saving money by not outsourcing some tasks to experts or software is really stepping over a dollar to save a dime. A service or a software that may come with a fee could actually save you significant amounts of money when you consider the time and energy that is spent on supporting that process in-house. Payroll, for example, especially this year with so many tax credits and payroll changes. These payroll tax companies invest significant amounts of money in softwares and training, even printing costs, to be able to do these processes more efficiently than we can do in-house. These companies are able to spread that investment over multiple clients, while if you were to invest in that same level of quality, it would only be focused on your organization and may not be as efficient. And while it does save us some money to actually calculate the taxes in our software, the risk of an error could be significant. Tax planning is another example where it may seem like an unnecessary expense, but if you allow your tax experts to put you in a position to save significant tax dollars, are you really saving money by skipping it? So when I say that we need to think about our accounting departments as profit centers, I mean just that. Cash flow doesn't just have to mean billing more for the work that we are doing. At the end of the day, cash is cash. Saving money on the back end is just as valuable as bringing cash on the front end. For example, bringing in a new contract requires us to expend labor, materials, subcontractor costs, and incur the risk of potential injury or budget overruns. If we could generate a $10,000 tax credit that doesn't come with those same risks, it's the equivalent of a $200,000 contract for a company with a 5% net income before tax. Likewise, if we can take an existing process and generate $40,000 in rebates, again, without requiring labor, materials, or subs, that is the equivalent of an $800,000 contract. And trust me, there are ways to generate cash flow even in an overhead capacity like finance. And when all is said and done, if you pay off your $3 million line of credit and no longer have to pay that interest expense, you have just brought in the cash flow equivalent of a $2 million contract. And these are all things that financial managers have the ability to do. So earlier I mentioned that while I've worked for firms of all shapes and sizes, I've employed many of the same strategies in achieving that profit center mindset, and I've included some of them on this slide. Right now, there is an insane amount of tax stimulus out there. If you understand the means by which you can qualify for these credits, you can work with management and owners to position yourself in a way that you'd be able to take advantage of them. I have generated over $2 million of tax credits for contractors with 100 to 150 employees. So this is out there, and there's a lot of it if you know what you're doing. One of the first strategies that I employ in any new organization that I work with is to immediately turn AP into a revenue stream by implementing a rebate program. These programs provide for essentially cash back on AP that we would already be spending on existing operations and projects. We pay our material suppliers and subcontractors, and we see immediate benefit through this rebate program. In addition, these programs also come with robust employee credit card programs that not only generate rebate on employee purchase cards, but they also provide a system of checks and balances to reduce employee misuse of your credit card. And as I mentioned, the Association of Certified Fraud Examiners year after year indicates that 5% of revenues are lost to fraud and error. I pride myself on being a strong agent of change and to spot processes and procedures that leave companies vulnerable to issues. Spend some time looking at your processes for AP, payroll, and employee credit cards to ensure that you have a strong system of checks and balances to help prevent and detect fraud. Rather than running lean and having a system where one person is responsible for entering invoices and paying those invoices and then reconciling cash, which leaves you vulnerable to theft, you could have a more fully staffed department that includes cross-training to protect against employee departure and also set up a system of checks and balances to make it more difficult for invoices or employees to be overpaid. While I'm looking at these procedures, I'm also looking at efficiency and whether or not the steps that we are taking are really addressing the risk or just creating busy work. By looking at the process as a whole, you're likely to find areas where you can automate a manual process and free up time for more valuable activities like implementing a rebate program or adding an additional layer of internal controls in a vulnerable process. And lastly, none of this means anything if it's not constantly being evaluated for efficiency. As accountants, we love data, and we need to be evaluating the areas that we've invested in, be it changes we make in the accounting department, investments in which clients we take out to wine and dine, or which projects and project managers are generating the most cash flow. Being able to have time and flexibility to prepare these ROI calculations can help determine the types of investments that are most effective so that you can focus efforts as an organization and double down. While those are just examples of some of my go-to strategies, new strategies are emerging every day. If I were to put on that slide, go get a PPP loan, that would not be relevant right now because that has already come and gone. So especially right now, with the ever-changing world of PPP loans and tax stimulus, building up your authority is going to be critical to identifying the newest strategies to stay on top of. Committing to your own education gives you an advantage in being able to identify and execute new and innovative cash flow strategies. In the world of finance, risk can be expensive. Internally, if a process lacks checks and balances or oversight, we are at a risk of loss from fraud, errors, or just time wasted on ineffective processes. On the outside, our banks, our bonding companies, and our clients are all evaluating our risk and what type of compensation they require to offset that risk. If a client knows that administratively our company is a mess, they may require bigger discounts for us to be the winning bid to offset that hassle. Banks will also charge higher interest rates for riskier clients to make it worth their while to lend to you. The presence of a strong financial manager who can maintain a robust system of internal controls can inherently reduce both of these risks and the expenses that come along with them. To further elaborate on the value added by investing in your own authority and education, let's talk about the 5 C's of credit. The first C of credit is the company's character. This is the reputation, integrity, stability, and experience of the organization, and many times banks and bonding companies consider the experience and integrity of the financial manager very strongly here because we interact with them quite a bit. Being able to demonstrate that we know our stuff means that they can rely on internal reporting more, giving them more frequent financial reporting and thus reducing their risk, or the conditions, the terms, the covenants, and those things that they put in place to reduce that risk of the business. I also once did a presentation with a banker, and he said that there is actually a 6th C to credit, and that is certification. Obviously, as the former chair of the Institute of Certified Construction Industry Financial Professionals, I would be remiss if I did not mention the CCIFP credential and how that really does bring value to your organization. Having a CCIFP credential serves as an external validation that you have specific knowledge of construction accounting. Banks, bonding companies, management, or future employers don't just have to take your word for it, but instead they can rely on the fact that you met the criteria to get certified in the first place. You had to pass an exam, keep up to date with annual CBE requirements, and keep your skill set relevant and valuable. The CCIFP credential is not a throwaway. It takes a lot of practice, experience, and knowledge to be able to pass the exam. Going through this level of effort shows your commitment to the construction industry niche, especially for the CPA firms out there. If your CPA is not a CCIFP, you really should have a conversation with them about why. Construction finance is only a tiny part of the CPA exam, and not all CPAs are construction experts. Finding the ones that are means that you have an accountant who is committed to the industry and is getting construction-specific CPE each year and is going to be better equipped to address the specific issues that contractors run into, especially when it comes to tax planning and tax credits. And lastly, having this certification really adds that extra layer of credibility and stability to management for lenders and sureties. I know for me personally, I am extremely committed to ethics and integrity because the threat of losing my licenses is significant. I've worked hard for those letters after my name, and I'm not going to jeopardize them for anyone. Most people feel the same, and lenders recognize this. So, what are some strategies that we can employ to really cash in on our authority and stay on top of potential cash flow opportunities? Webinars. These are a great way to get updates shortly after changes happen. Most CPA firms, advisors, and other service providers scramble when new rules and regulations come out as a means to provide value to their clients and potential clients. These advisors are experts and they are studying these changes as they're happening, so they're able to get information out quickly. Many service providers even give these webinars out free of charge as part of their marketing and client value add, not to mention organizations who provide regular webinars to members as part of their member benefits. Many organizations also put out newsletters on a regular basis, as well as industry journals, which are a great source of trending strategies, best practices, and other information. Don't just discount these as spam when you get them in your email. Really read through them. Many times this is free education and something may seem like it's not relevant to you, but it may have just not been a situation that has hit you yet. And while those things are broad education, you can also reach out to CPAs, advisors, and peers for best practices in internal controls. For those of you with audited financial statements, your CPAs are already looking at your internal controls, and many are happy to give you some ways to be the gold standard. Even without that, see what other contractors are doing, and even if you never act on it, you know it's a possibility if you ever encounter a similar situation later. Conferences and seminars are a great way to get very high quality information that is very targeted and relevant. You can get a ton of information in a short amount of time, and each year that you attend, your knowledge base is going to be more robust. And lastly, invest in yourself, whether it be pursuing formal education, advanced degrees, or your CCIFP credential. Don't discount the value of book smarts. So we talked about how you can invest in yourself, but there is absolutely no expectation that you need to know everything alone. Deciding what not to do is just as important as deciding what to do. If your workload is a river, relationships are the current. Strong ones help push you forward. And the inverse is also probably true. It's important when we talk about value that we don't discount the impact that internal stakeholders play in determining and achieving value. You want to align your efforts with what owners and managers consider to be valuable. If you spend hours trying to revamp a process that nobody wants changed, then that wasn't a valuable use of your time. None of these recommendations are expected to be implemented in a vacuum, but rather these should be things that spur a conversation with other internal stakeholders like management or owners. And there is simply no way to have a set of financials that are both accurate and timely without the help of those in other departments. What comes out of our accounting software is dependent on what someone downstream put into it and when they did it. Having a strong relationship with those in a position to influence others' ability to meet your financial deadlines or your policies can go a long way to reduce the time spent on follow-ups and fixes. But our relationships outside of our firms are just as important in generating value. Vendors and client relationships aren't just for the operations folks. Financial managers are responsible for making decisions about when and how to pay vendors and communicating with them in regards to payment status and things that reduce red tape on their end. Vendors and clients are also assessing your creditworthiness and using that to determine the terms and their pricing. You are more likely to see beneficial pricing or payment terms if you have a strong relationship and you clear red tape. When cash is tight, the worst feeling in the world is to find out that a large payment is on hold. Having that strong relationship with clients may even result in checks being released because they trust that the piece of compliance that might be missing will be fixed timely. It's important that we have peers who we can run ideas past or pick their brains on how they're addressing issues. Many times, our peers have dealt with a situation that may be new to us, or a service that they've implemented, a new vendor or a client, and that information can be very valuable in the future. Having strong relationships with business advisors is also critical as a means to leverage their skill set versus building your own from scratch. It is not feasible to maintain our own education to the point of being as skilled as a partner at a CPA firm or a banker or a surety or a lawyer. But it is feasible to maintain a strong relationship with people who do have that skill set, where we can bounce ideas off of them and take advantage of that relationship beyond only calling when you need something. So here are some tangible things that everyone can do today to help bring value through their relationships. You can make it a point at least monthly to call up a peer or a coworker in another office and just listen. Ask them how they're doing. What challenges have they experienced? What successes? And just listen. These may be things that impact you in the future, and learning from others is a free source of information and best practices. Get a meeting together with your banker, surety, and CPA at least by mid-year, if not quarterly. Keeping them up to date with what you're dealing with, successes you've had, and challenges as they're happening is critical, especially with regards to your CPA firm, who can help intervene with tax strategies before a transaction is finalized or a deadline has passed. I've found out about significant tax credits initially from a quarterly bank meeting, and I was able to get it onto a timely filed return and collected much faster than if I had to amend. You want to participate in formal year-end tax planning before year-end. So this is like November or December for calendar year-end clients, especially this year because of all of the changes current and expected in the tax code. Many times transactions have to take place prior to year-end to generate tax savings, so you could be missing out on valuable tax strategies if you just submit your numbers to prepare a tax return. Don't discount the Vendor Expo at conferences. I mentioned early on that I always implement a rebate program as part of my go-to strategies for generating cash flow. That relationship actually started at a CFMA conference vendor exhibition. I think a lot of times we don't want people selling us stuff, but if you have problems that could be solved with a more efficient process or software, it could actually be a win-win. And I have actually earned so much more on those rebate programs than I have ever spent. It's almost just a win versus a win-win. So don't just focus on your book smarts, because street smarts matter too. So I know what you're thinking. None of that other stuff is my job. My job isn't to build relationships or read articles. My job is numbers. Well, don't worry. That's the most important way to add value of all. Accountants tend to report historical data, many times months after the period closes. Telling you today that we messed up in June isn't useful. Instead, it is so much more valuable to be able to say in March, hey, if we don't act, we are going to mess up here. So instead, we need to be looking forward and using the historical information that we prepare as the basis of forecasts to alert managers and executives of future cash flow issues. Being able to read benchmarks and trends is also critical to being able to identify areas of concern or potential opportunities. Outside of the accounting department, KPIs can have a significant impact on achieving corporate goals. As financial managers, we can help take historically reported information and use it as a tool to help motivate future goal achievement. Before embarking on a benchmarking exercise, it's important to know what data is available. What information do you track in your system? It doesn't make sense to try to set benchmarks on things like employee satisfaction if that's not something that has already been tracked over time, since there would be no historical trend to compare your current results again. Start where you already have consistent and comparable data. Leverage your relationships with internal stakeholders to either understand or develop the corporate goals and objectives. Putting out KPIs that don't move the needle can cause employees to lose focus and engagement. Instead, focus on those KPIs that are really going to motivate the behaviors necessary to meet your strategic objectives. And don't reinvent the wheel. Look at the strategies and the available data and play matchmaker. You may not track that particular ratio today, but as long as you have the recorded data from prior periods to produce that KPI, it's a good KPI. And then at regular intervals, you want to check with your internal stakeholders to ensure that the KPI is actually motivating your team to meet goals. I have seen time and time again firms who try to use sales growth KPIs only to find that by putting benchmarks on top line growth, there was no incentive to preserve the bottom line profit margin. So while they were bringing in more business and more revenue, at the end of the day, the company was actually worse off financially. So in order to put historical financial information into a forward focus, it's important that we have a system of benchmarks that we find valuable to our organization. What things are important enough for us to measure regularly? As you track these metrics month over month, you'll start to see trends. Maybe there's a certain segment or a job type or a PM that consistently operates different that you can identify for more analysis. Figuring out what makes those projects different can be very valuable analysis if successful jobs can be recreated or poor performing jobs can be prevented in the future. It's important to look at your benchmarks from different angles, not just period over period or month over month. Instead, dissect the same number multiple ways to see if it's telling a story. For example, if you consistently bid your projects at 10% margins and your overall gross profit margins are 10%, you might think, yeah, I hit my target and move on. But if one PM is consistently generating 20% margins and another is generating 5% margins, even though the overall blended margin is 10%, there still may be an opportunity out there for improvement in either estimating or performance if you can figure out why that one PM is able to achieve 20% margins or why somebody is getting 5% margins and correct that. So we are the keepers of a tremendous amount of historical data. And while it happened in the past, it can help give us an idea of where we will be in the future. Simply tracking data points like cash balances in a graph can give us a visual look into trends or cycles. If we know our AR balances today and our average day's sales, we can project out how much cash we expect to collect in the next 60 to 90 days with enough accuracy to be able to identify if we are going to have a cash crunch. Being able to identify that today gives us an opportunity to either focus on billing more or collecting faster during that window to mitigate the issue later. And while I know we all love Excel, much of these forecasts can be done very simply using tools like Power BI. Below is a hypothetical example of a 90-day cash forecast that can be automatically generated in Power BI by simply loading the last year's worth of daily cash balances. Individual transactions or daily balances are typically things that are easy to download and upload into an analytical software like that for a quick and easy forecast that, for me, I found to be reasonably accurate. And also visually, you can kind of see when you track this in a graph format that we have a little bit of a cyclical nature. So we know when we go into these, peak periods that this is only going to be temporary and to not give away the farm. By tracking your expected future cash flows against your known or average expenses, it can also help you identify periods of weak cash flow in advance while you still have time to mitigate it. Maybe that's holding a check run until the next week when a big collection is expected. Or maybe that's putting all hands on deck to get a big billing out and approved as early as possible. Once those checks go out or that billing cutoff has passed, you can't change it. So early detection really is the key. And that's it for me. If you have additional questions or you want to bounce some ideas off me, you can always email me at heather@constructioncashflow.com, or you can click the link underneath this video to be able to set up some time for a 10-minute chat. I am more than happy to answer any questions that you have. Thank you again for watching. I hope it brought you value. See you next time.